let's start with the basic one, the vanilla bond. So it pays, right, a fixed coupon every period, and it returns the principal at maturity. This is the example that we gave earlier with the 2.5, and then it gives 100. So if the yield to maturity goes up, the price must go down. This is the first, if you want, relationship that is important to understand. Now, you have to think of it this way. Suppose that the bond was giving a coupon of 5% and it's priced at par at 100. So the price is 100 and gives 5%, so 5 every year. At that moment, the yield to maturity is also 5%. Now, let's assume that the market changes and suddenly bonds with a similar risk, right, similar maturity, now they're giving a higher coupon. They're giving like, I don't know, 7% or 10% for the same price of 10. Then your old, 5% is now less attractive. So the price must fall until the total return that the investor can get from the lower price and the 5 coupon match the new one, right, in the new environment. And when I say yield here, I mean, yield to maturity, not just coupon divided by price. Coupon divided by price would be current yield. Yield to maturity is here in the formula, is the internal rate of return, actually. It's what equates, this with the current price. So anyway, higher yield, lower price, and vice versa. Now, not all bonds move, just like a vanilla bond. You have a different type of bonds that have a slightly different shape. In particular, bonds that have an option that is embedded to it, like callable bonds and puttable bonds. Those are, bend, if you want, the curve. A puttable bond give the investor the right to sell the bond back to the issuer at a specific price. So it cannot go below this specific price, right? If you can sell the bond back to the issuer at, let's say 50, then the price will not go below that. So even if the yield to maturity increases, the price is stuck here. So it doesn't have the same slope as a vanilla bond that would continue actually to decrease. For the callable bond, it's the other way around. It gives the issuer, the one that is borrowing, the right to buy back the bond at a specific price. So imagine now that the rates are decreasing. So it is possible he financed himself, the issuer, like it was a company, it financed itself at 5%. And now suddenly it's possible to finance, like all the rates are going down, and it's possible to finance itself at 2%. If it was a normal bond, then it will be a vanilla one without an option. It will be very precious to have something that is now giving 5% when everything is giving 2%, for the same level of risk. So the price would have gone up. But for the callable bond, it's going to be limited, because the issuer will be like, well, in this case, I prefer to buy back the bond, right, and just issue a new one. And why it's not a perfect line? That's because of the convexity effect, and we'll get to it in a second.